Dave, thank you very much for giving me the opportunity and for putting on a good show for people. 29 minutes, a little bit brief for me to teach people everything I've learned in 51 years in the markets. But let's see what we can do. So the usual disclaimers right over here. I'm going to be talking to you today about seasonality. And let me tell you why. In the 51 years since I made my first trade in the summer of 1967, I've learned a lot of things. I've learned more things about traders than I've learned about trading, which is not to say that I haven't learned a lot about trading, because I have. But the bottom line is this. Traders love to work hard. Traders love things they can't understand. Traders are attracted to the magical and mystical, and traders hate following rules. It's just the nature of the beast. The one thing I learned about my trading is this. When I have rules and follow them, I make money. Not every time, but a good deal of the time. When I have rules and don't follow them, I'm trading from the seat of my pants and I lose money. I loved the last presenter. He was great. Not because I'm a fan of options. Frankly, I don't understand them. I understand the concept, but I don't use them. I loved what he did because it's statistical and it's rule-based, and I give him a lot of credit. When we trade with seasonals, we trade with rules. Seasonality is by far and away the absolute best thing that I've ever found, ever researched, and ever done in the markets. When I say best, what do I mean? I mean most accurate, most profitable, and easiest to do. So immediately, that flies in the face of what most traders like. It's easy to do. Traders love difficult things to do. Number two, it's statistical. We know the facts. And we don't just know the facts going back a few days or a few months or a few years. We know the facts going back over 100 years if we want them. I'm going to give you a little tour of what we do. Obviously, as I said, in 29 minutes, I can't do everything. Let me give you some examples. First and foremost thing is this. If you like clarity, objectivity, proof of the concept, proof of procedures, exact rules, no looks like, no myth, no magic, no interpretation, no analysis, absolute exact entry and exit strategies, exact determination of risk and reward, profit maximizing strategies, that's all available to you through the use of seasonality. And it doesn't need to use any fancy terms, any myth or magic, any arcane charts, or any stuff like that. No Fibonacci, no Elliott wave. Let's go to the next slide. Let's talk about the trading genie. And I want you to think about this and be real and be honest with yourself. What are the things that every trader must know or thinks they must know or wants to know about trading? I'm going to go through some of them with you. And I respectfully submit to you this. If you even know half of the things I'm going to show you, you are way ahead of most traders. And believe me, I have trained hundreds of traders, traded thousands of times. I know what the hell I'm talking about. So the first thing you want to know is what to trade. A stock, commodity, Forex, option. You want to know what to trade. You want to know exactly whether to buy or sell that market or spread. You want to know the exact time of day or price to sell short or to buy within 1 minute or less. In other words, you want timing. You want to know your odds of success, your average profit, your average loss, your stop loss, your risk, your profit to loss ratio. Are you making more money when you're making money than you're losing when you're losing money? You want the complete track record. So if someone says to me, hey, here's this great strategy for options, I want to know, how often has it worked? How many trades have there been? What's the track record? The average profit, the average loss in points and percent. What has been the worst trade ever and the best trade ever? What's your maximum drawdown? In other words, how bad do things get in a number of successive losses? What's the maximum upswing? How good does it get? The number of consecutive losses. the number of consecutive profits, the accuracy in percent. In other words, how accurate has this been in the past? What percentage of the time has it been correct? We want to know how to minimize the loss, how to maximize the profit, when to move your risk to effectively zero. In other words, when to get what I call a free trade. Let me get my pointer if I can find it. One moment, please. Get that pointer here. And here we go. No, it won't show up. No big deal. We want to know when to move our risk effectively to zero. We want to know when to get out. We want to know everything with complete objectivity, no interpretation. When I teach something to people, I want to know this. If I take 100 people, assuming they're not brain damaged and assuming that I'm a good teacher, and teach them the same exact strategy, I want to be able to get 100 answers that are exactly the same for the question that I'm going to ask without anybody else consulting with anybody else. In other words, complete objectivity, crystal clear, no opinions, just facts. I don't want to have anything subject to interpretation. I want everything to be proven, valid, and reliable. I want it to work in stocks, futures or spreads, Forex, and I want it to be adaptable to your risk level of tolerance, your tolerance level. That's not too much to ask for, is it? Well, we can get that with seasonals. So the problem is this. Most people find it boring. Most people like the challenge of trading. I don't like the challenge of trading. I like the results of trading. So if we look at some examples, what are people using in the markets today? They're using chart patterns, retracements, Elliott waves, Fibonacci, breakouts, support, resistance, artificial intelligence, correlations, earnings, fundamental cycles, astrology. Everything that people use in the markets these days is based on patterns. Artificial intelligence looks at different patterns and analyzes them and makes a prediction. Fibonacci is a pattern. But here's the good news. The good news is there are literally thousands of patterns. The bad news, most patterns don't work. How do we know they don't work? It's really simple. We use a computer. Amazing concept. Go to the computer and ask the question, does it work? Example. Let's go to the much vaunted 50 and 200-day moving average, the so-called golden cross, the 50 MA crossing above the 200 MA, or the death cross, the 50 MA crossing below the 200 MA. The reality of it is the back test does not show it to be valid. The good news, we can test it. The bad news is it don't work. Example. Here is a statistical backtest of the 50 versus the 200 moving average going back the last 47 trades, which is a long time actually. What do we see? Well, in the upper right hand corner, the red arrow shows that it's been right about 27% of the time. If you like 27% accuracy, this is good for you. Has it lost money? Yes. Arrow on the left. Looking at the bottom, it's had a maximum of 3 consecutive winning trades and a maximum of 11 consecutive losing trades. Let's talk about 11 consecutive losers. What does that do to your psychology? We know that most people can't lose money more than 3 times in a row without throwing in the towel. They lose money once, they figure, hey, that's normal. This market is not perfect. I didn't come into this expecting 100% accuracy. They lose money 2 times in a row, they're not happy, really unhappy. They say, maybe there's something wrong with this method. Maybe there's something wrong with me. But they stay in the game. They lose money 3 times in a row. The 3rd time they're saying, wait a minute, I didn't sign up for all this stress and pain. At that point, they usually change their strategy or they give up. So imagine a strategy that's wrong 11 times in a row. By then, you're either out of the game because you're psychologically unhappy or you're out of money. Let's compare. Let's take a look at a track record. This is the track record of the 50, 200, 50, and 200 cross back to 1953, showing what? Showing a most horrible equity curve. So why do people do it? Because they believe. Why do they believe? Because there's been one good run in the 1980s to the early 1990s where it made money, and then it's given it all back plus more. Compare that to a different strategy. Strategy based on a 4-day precise pattern, price pattern with a target, a stop, and a trigger. 100% rule-based, no judgment, no interpretation. We put it all on the computer, and the computer tells us what to do because it knows the track record. And here's the track record right here. Compare. 947 instances of trade. Makes money, showing on the top left, after commission and slippage, one contract at a time in futures. 84% reliability, in other words, accuracy. Just one moment, please. Can I get some quiet, please? 33 winning trades consecutively, 3 losing trades. And here's the good news for many traders. If you look at the very bottom, it's in most trades about 2 to 4 days. So it's in its losing trades about 4 days, winning trades about 2 days, 2.5 days. And beautiful thing is, after commissions and slippage, it's making $231 a trade, over 947 trades with an equity curve that looks like this. So what's the difference? The difference is objectivity, clarity, rule-based, etc. So what the heck does that have to do with seasonality? Well, let me show you. Can I get some quiet, please? I'm so sorry, ladies and gentlemen. We use a trading model called setup, trigger, and follow through. A setup is a pattern. The pattern is tested over time, and we answer the question, how often has this pattern occurred, and what has been the accuracy? We know that. But we know that even if the accuracy is 80% over many, many years, 80% is not 100%. 80% is 80%. Is there something we can do to boost that 80%? We use a trigger. The trigger tells us when to do the trade and increases our probability. After that, we need follow-through. Follow-through consists of 2 parts, profit and managing loss. But managing profit is much more complicated than that. It's not just managing profit, it's maximizing profit. So using this model, which is our structure, we are very, very, very able and capable in making decisions that are completely objective, which also allow us to maximize profit. So what are we going to do? Important rule. Whatever you do in the markets, if you can't test it, don't trade it. Think about it. There are a lot of people in this business who want to keep things very vague and unclear so that you can come back to them and say, it's not working for me. So they can say to you, well, of course it's not working. You don't have all the facts. You need more training. You need to buy more books. You need to buy more webinars, more seminars. You need to buy more software. You need better charts. There's so many things they can sell you. So I say to you, don't become a victim of that trap. If you can't test it, don't trade it. Things may look good over the short run, but over the long run, many things fall apart. So let's talk about seasonality. Seasonality is defined as the tendency for prices to move in a certain direction at certain times of the year. There are a number of seasonals which we will explain in the future, but let me show you one. If we looked at the Dow Jones from 1901, get that 1901 to 2017, and we made one graph that represents the average behavior of the stock market based on the Dow Jones over all these years, this is what we would see. A little higher in January, February, March, April, levels off in May, June, has a little peak up in July, comes down from July until late mid-October, and then goes into the strongest part of the year, which is right now, October, November, December. And this year, which is not in the data, this looks very similar to this. In fact, we can zero in on this and give the exact date. And that exact date, October the 26th, and I will show that to you. And we knew that 15, 20, 30 years ago, based on history. We can take a graph, for example, this one, industrial average, showing how the current market relates to the cash market. This is the Dow Jones again. You notice I put two circles on the bottom of the chart. The lower right-hand circle with arrows up indicates by week the typical behavior of the market, as it does on the left-hand side in April. So we have two very strong periods of time, the first 3 weeks of April and the last 4 weeks of December and the last week of November. And it begins in mid to early October. But I'm not happy with this. I want more. Why do I want more? Because I want precision. It's not enough for me to say to you that from 1980 to 2018, the Dow has gone up consistently during this period of time, as evidenced by the green arrows at the bottom of the screen. And by the way, if you want more information on this, go to one of my websites, seasonaltrader.com. There's a course there that you can sign up and get for free that teaches you how to use seasonals. But here's the thing. I want more accuracy. But wait, I can do the same for copper. I can do the same for copper over many years, 1890 to 2008. I can divide the copper data into different ways of looking at it by telling you when is the most probable period of time for up moves and down moves. Example, April, May, June, up moves, and other moves down with 77% accuracy, August, September, October, over many, many years. I can make a chart of copper futures showing the strongest period of time from mid-December to February. But I'm not happy with that. I want more. What I want is this: exact dates. If I go to my database at seasonaltrader.com, which is available to anyone who wants to subscribe, and you don't need it, you can do it yourself if you want to, but you may not have the same exact database in terms of the number of years. I asked the computer a question. For the month of December, show me all trades in copper futures, or stocks if I prefer, that have been right 70% of the time, that have had a duration of 25 days or less, that have been right over 70% of the time, that have had a reasonable stop loss. Computer comes back and says, this is what you're looking for. Buying copper, close of trading December 18th, the top of the chart in yellow. Getting out on the 24th of December has been right 78% of the time, with an average profit of 3.68 cents in copper. Each cent in copper being worth $250, or is it 150? I can't remember. So we know all the statistics. So let's review. What do we know? We know what to buy or sell. We know when to get in. We know when to get out. We know the stop. We know the average profit. We know the average loss. We know the number of years in the trade. We know the number of consecutive losses, consecutive profits. We know the entire history, and we can look it up in detail. So let me show you another one. Dow Jones from the 1920s to now. Here's the composite chart of 3M. Look at the bottom chart. What does it say? Look at the box. Look at the arrows. But again, I say, I'm not happy with this level of information, even though this level of information is far above and beyond anything that most traders have. I want more specifics. I want to know exactly when. So I go to the computer and I say, let's find 3M, and I do a seasonal search, and it tells me, here's one trade in 3M, buy on the close of trading February 9th, get out February 20th, 81% accuracy over many, many years. And this is what the trade looks like. In fact, this is what it looked like in 2018, right over here on those dates. And we knew that before. Let's talk about psychology. Going into this trade and knowing it was supposed to bottom where that purple line begins, you're looking at the chart and you're saying, oh my God, this chart looks terrible. It can never happen. We knew the pattern. We knew it was 81%. So what did we do? We applied a timing trigger that answered the question, will it work this year or not? Is the probability sufficient? Should I get into this trade or not? And that's why the way the process works. The seasonal is the setup, the trigger is the timing trigger, the follow-through is the profit per trade, and the maximizing strategy. And we can take a trade, for example, this one in a spread, and look at every single year. Here's a spread over 45 years of history. Look at the very top where it says trades. 45 years of history with 93% accuracy exact entry date and exit date, equity curve, and so forth. What if we went back in the Dow Jones? Earlier I mentioned the October 26th date. Here's a trade going back to the 1920s. Entry on the long side in the Dow Jones, October the 26th, exit January the 10th. Now, to most traders, this is a long-term trade. Why? Because you're in it for such a long time. Most traders get out of their winning trades very quickly, but they love to keep their losers until they grow hair on them. Here's the opposite situation. What do we know going into this trade? Ideal buy date, October 26th, exit date, January 10th. Profit to loss ratio, 10.6 to 1, meaning historically, the sum total of winning trades has been 10.6 times larger than the sum total of losing trades. We know the average profit's been 195 Dow points. We know the stop. We know the percentage win, percentage average profit, percentage average loss, maximum consecutive losers, and we can look at the history, every single year of history if we want to. Now that, my friends, is statistical research that's valid. Now, this trade here was generated before the 26th of October this year. What has happened so far? Has it been working? Take a look at the chart and you'll see. Now, you might be saying, but what if the Democrats gain the advantage in the House? Isn't that going to make the market go down? Well, we're not going to worry about that. We don't have to worry about that. Why? Because this trade has already reached its average profit per trade, which is 195 Dow points. These days, that happens in 1 day, in 1 hour, in 2 hours, and we're out of danger. So we've taken the money off the table in part of the position. You put in a trade, a stop, a break even, or a trailing stop, and the more positions you have, the more flexibility you have on exit. And this can be done in futures, in the YM1 or the YM, and done in the S&P, the day session, the full session, and there are a number of ETFs by which you can take advantage of this trade. But don't let me stop now. Let me continue. How do we do this? Very simple. If I wanted to do a search for copper trades over the entire year, I'd highlight copper, pick all the months of the year in blue, put in my percentages, and lo and behold, it gives me my trades. Very simple, very straightforward. Let me show you another trade that you might find interesting. Heating oil. Look at the chart. Beginning trading in 1980, this period of time, beginning the second week of March to the end of April, has been the most bullish time of the entire year, as evidenced by the arrows up. What do the numbers mean? In the boxes, the numbers mean percentage of time up or down. So, first box, 66 plus arrow up green, meaning 66% of the time since the start of trading in heating oil futures, this market has been up that week. Beautiful chart, and if you don't believe me, look it up, and we can zero in on exact days. So this is our strategy. There's a live demo at seasonedtrader.com showing how we find these trades, and you can see the factors are very specific and clear. We have a profit maximizing strategy, and by the way, I realize I'm going fast. I've got to squeeze a lot of information in here, so take your time and rewatch the video when you get it. This will help you understand this a little bit better. Here's another example of a search for copper in March, April, and May, and the results that come across very easily. What about currencies? Here's a trade in Canadian dollar, October 1st to October the 7th, and this chart shows the period of time for this trade in yellow. And here is the entire history of the trade in Alcoa, year by year by year, 45 years, showing closing price on entry, closing price on exit, performance and stop, year after year after year, including the performance each year. So that's what I like in my work. Want to trade S&P? Here's a trade that's coming up, December 15th, December 30th, 79% win since the start of trading in S&P futures. So look, there's a lot of information here. It's all statistical. It's all very clear. Let me tell you a couple of more things. If you haven't read the book, The Behavior of Prices on Wall Street by Art Merrill, M-E-R-R-I-L-L, you should do it. He talks about the pre-holiday trade, buying before Christmas, the day before Christmas, the day before Thanksgiving. These are both coming up. Very beautiful track record, 73% accuracy. So read about that and do some research on your own. So let me show you what else I can do for you. Yes, I will be having a webinar 18th of November for 3 hours, in which I'll be giving my 2019 annual forecast before 19 even begins. My annual forecasts have been very accurate. Last year alone, in November, I predicted the big bull market in stocks. We've been bullish on stocks for 7 years now. Big bull market in palladium, big bull market in copper, big bull market in silver, which is beginning, bull market in coffee, and many, many other things, including stocks and real estate. Just to suggest you attend. And Dave, you want to put up the link where you can get the information on the trade. If you have any questions, you can reach me at jake@trade-futures.com. If you want to mentor with me, there's a link for mentoring. I want to thank you for attending. And Dave, I want to finish on time and not be a hog, so I'm done with it. Any questions? Jake@trade-futures.com. Thanks, Dave. And thanks everybody for attending.